We have some colleagues from France who are part of this great program called HEC Entrepreneur, and some of the students are here to continue their acceleration here. But one of the topics that we get a lot of questions about from students who have been in this program before is, great, fundraising in the Valley seems really awesome and easy, which it's not, by the way. But how do we raise money when we're back home in places not so as flush with money as Sand Hill Road? So that's a topic that we wanted to expand out to, and we've invited Olivier, who is a venture capitalist and has been part of the finance community outside the US, in France. And I think there's some lessons there that I think he can share with you guys about how to fundraise in those kinds of markets. So no further ado, I'd like to introduce Olivier Younes.
Thank you. Good afternoon. Thank you to Vicky and to Ken for this kind introduction. So the idea, effectively, is to go through 15 questions as for a quiz. And these questions are based on the way one may raise money in Europe in general. You'll see that there are a lot of fundamental things that are connected to the way funds are raised in here, and some that are just light and shades things. So it's International Venture Capital Quiz. So it will be about a quiz. Okay? So 15 questions. Please interact, raise your hands, and preempt the answer. Just 2 words about my background. So I am an affiliate professor with HEC Business School that is ranked #1 in Europe for business, in charge of entrepreneurial finance with HEC Entrepreneurs. So I'm here with 5 of my students. And also, I've been a VC for the last 10 years, and now I created a corporate finance boutique, and we help funds deploying their capital on the one hand, and on the other hand, we help startups raising funds. So my company's value proposal, that will be the very last slide about this, is to provide as an advisory and a certified public accountant both parties, so entrepreneurs on the one hand and VCs on the other hand, helping entrepreneurs in their business plan, fundraising, and bookkeeping things, while for VCs, it's about due diligence, reporting, and companies' valuation. And in the arc of 2 years, we've been ranked top 15 in the different area. So let's begin. 15 questions. The first, what is VC about when it's about matching things? Please raise your hands. What is the name of the game? What is it about? Yeah?
Matching capital with ideas.
Perfect. So you have 1 point. You have to count this, okay? So you get 1. It's about effectively matching ideas or entrepreneurs with VC that are just managing on behalf of other persons or companies, funds, and deploying them in non-listed companies. So second question, what is an entrepreneur? It's here on the picture. So can't see it? Where's the founder in here, according to you? Where? Here's the founder. Okay? This is sort of a balance, you know. This is a Calder mobile, so it just is a moving, balanced thing. And so this is the founder, actually. And according to you, what is he trying to balance between the different forces around him in order to build the company and create value? Come on. I don't know, products or tech or clients or... Yeah?
To make all of the forces working together.
Yes, okay. So which kind of forces?
All kind of forces. I mean, it can be sales, can be
Yeah.
investments.
Okay. Okay. Another suggestion, yeah?
Time, cost, and performance.
Time, cost, and performance, good. Other suggestions? Yeah?
It's to create synergy between all the skills of the team.
Okay, all the skills of the team. But basically, yeah?
To develop your passion.
To develop your passion, yeah? What is a prerequisite for any venture? To have a team, absolutely. So there's the team here. This is the team, as you can see. It's so this is the team. What kind of other prerequisites for a company to be launched? Yeah.
To have a product or service or idea.
Idea, yeah. Market. Who said this? Okay, market. So first of all, there's the market, and we talked about the traction of the market, the mix of the market, the way the market is perceived and structured. Then there's the team, and at the end of the day, according to you, what is the third force, which is the topic of now, that has to be balanced? Yeah? Money. So VCs. So this is the way the research in management and in entrepreneurship represents the entrepreneurial company. And what is the way, in order to finish with this slide, what is the way one founder can make the balance between all these different forces, according to you? What is the conventional tool, something that you just create from nil, that makes possible to balance the different forces around you, market, team, and VCs? The business model, the business model. Okay? So this is an entrepreneur. And Jeffrey Timmons, that is now he's dead, but he was a very famous entrepreneurship professor at Babson University and first at Harvard, conceived this. So this is the official picture of what an entrepreneur is. So the founder is here and jungling with the three balls and having just arbitrage and trades-off between the fact that eventually the opportunity, so the market will grow or will decrease, and the way that he will manage to have some kind of matching with the team and resources. So third question, so no winner for the second question. Third question, what is the VC's motto? What is the slogan? This is not a slogan. This is the hidden agenda. So yes, but the motto, do you know Sequoia Capital? Everybody knows Sequoia Capital? So what is their motto? Yeah?
Is it the entrepreneur behind the entrepreneur?
Absolutely. So you win this question. The entrepreneurs behind the entrepreneurs. That shows, at the end of the day, that in order to finance an entrepreneurial company, a financier has to behave like an entrepreneur in real life. This is not about bank. This is not about classical way of financing things. It's about flexibility. It's about balancing different forces that are huge around people. So, fourth question. Who are these two guys that are supposed to have created VC? Christopher Columbus here, yeah? And his father. No, he's not his father. No, because it's a color picture, so maybe, So this is Christopher Columbus for sure. You have half of the question. And? Ford. No. Henry Ford. No.
Keynes?
No. Someone really known in here, in this area. He's a French guy. He went here and founded the local VC industry in the valley. No? Okay. Georges Doriot? Colonel Doriot? No? It was during, just after World War II, and he just had the idea of having the tech that would have been and were developed for war purposes, to have them financed in for civil applications. So he went here and he just created the very first VC fund here. So you have half of the other point. Fifth questions. Where does VC's dry powder come from? Do you know what a VC's dry powder is? Someone knows what it is? It's the available cash to be invested in companies. So it's named dry powder, like for a pirate, you know, to shoot. So where does it come from? You have a VC in front of you as an entrepreneur. You're pitching your idea. He's quite interested, and he says, "Okay, we may invest, I don't know, $1 million in your company." Where does this $1 million come? Where does it come from? Yeah.
From other investors, big companies who want to get large gains.
Yes, but what kind of other investors are behind this VC?
Hedge funds.
Hedge funds, yeah, maybe.
Universities often.
Absolutely, university endowment things, yeah. What else? Pension funds, you win. So pension funds, banks, individuals, professionals, wealth management thing, and big companies if it's about corporate finance. Question 6, what is the VC's business model? How does a VC actually get funded and creates money for his on behalf on his stakeholders? Is it connected to a profit and loss? Is it connected to the margin, the operational margin? How does it make money? Yeah?
I'm not sure how it makes money, but I know it's the 80-20-7.
Yeah, absolutely. Yeah, that's perfect. Could you just elaborate on this?
I don't know. The way I just have heard about it through reading like articles. So
Okay.
I can't help.
Okay. So say the three numbers again.
80, 20, and 7.
80, 20, and 7. This is not exactly the thing. The three numbers are 20, 2, and 8 or something. No, not sure. Okay. So the 80-20, you have them here. 80 here, 20 here, and the 8% per year, it's the hurdle rate. So it's the minimum that the limited partners have to gain in order for the management company to get some value out of it. So if we go through to it, first you raise as a VC, let's say $100 million. So this is for a long period of time to be invested. It's roughly about 10 years. So the 5 first years are used to deploy capital, and then the 5 last years are here to go through the exit and have the capital gain and appear. So you have 100 million euros under management. Every single year, you have to pay for wages, you have to pay for rents, for marketing, due diligence, and so on and so forth. This is roughly a 2% thing. So every single year, you pay 2%, and you take this 2% out of the 100 million euros or dollars under management. So at the end of 10 years, to make it very simple, you just have as dry powder $80 million. So when you have in front of you a fund claiming that he manages $100 million, you know that he only manages $80 million, because the 2 times 10 years $1 million are just used on a daily basis in order to have everything work. Okay? So you have the $80 million. If the fund perform a 2 time as a performance, so investing in different companies, selling them through trade sales or through IPOs, and then getting the cash back, he may, playing on the $80 million, get $160 million. And then this $160 million go divided between the general partners on the one hand, so the management company that keeps 20%, and the LPs, that is the different subscribers. So that effectively what you just said about the 80, 20, and the final number, which is 8 or 7, depending, which is the level of minimum IRR from the limited partner standpoint to have this mechanism work. Okay, so you win the point. Congrats. We are near half of the session, so question 7. What does the VC's value creation look like over a period of 10 years? Is it a linear thing? Is it something that is really difficult to predict, or is there a typical J curve eventually? Yeah? How does it look like?
Looks like J.
Yeah.
It goes down initially,
Yeah?
and then it shoots up.
And do you know why it works like this?
It takes time for company to develop and gain some value. So you invest, you wait 5 years, and then you get.
1 point. Everybody's fine with it? So it's just because you have, let's say, an average holding period of 4 to 6 or 7 years per company in the portfolio. So first, you absolutely, as you said, you are just having drawdowns. You invest in cash. Cash is going out of the fund you're managing as a VC. And then at a certain point, around year 3 or 4, you gain capital by performing trade sales or IPOs. And then you have some kind of distribution and you have some kind of cash in. And this is a cumulative curve, which makes the J curve. So it is very difficult as a VC to work in this area, just because you know that for the beginning, the 2 or 3 beginning, 2 or 3 years, you will have difficult times with drawdowns and with value destruction. Question 8, are we alone in the universe? Yeah? No. No. Okay, could you just elaborate a little on it?
Well, I'm assuming in the context of investors, there's also angels and strategic investors, and there's grants and funds.
Absolutely, absolutely. So 1 point for you. Eventually, it's a continuum of sources of financing that are, or that may be in overlap in here, for instance, with government grants and loans on the one hand, with angels and groups of angels. At the very beginning, you have your 4F, founders, family, friends, and fools. And then you go through the entire process, and you can leverage your position on the market, and get more money poured into your company. So that's 1 point for you. Question 9. Is VC similar to a bank's loan? No. Could you just go through the different themes and emphasize on the main difference? For instance, what's the job of a VC compared with a banker?
I think it's the same.
You think it's the same? Okay.
When you're a VC, you're more consultant than a bank.
Okay, so this is for the hands-on thing, absolutely. But just for the nature of it.
And
When you're a VC, what do you hold, yeah? Oh, come on, please.
Also, a VC is mostly, providing money for more of an idea or a concept, whereas usually like a bank is something specific, like a mortgage on a house, so it's much more concrete.
Okay.
A VC is much more abstract.
But both are giving money, are providing money to the company. Are we okay on this? What is the counterpart?
VC have a control on the company, but don't have the control on the decisions.
Okay, maybe. So it's about corporate governance. So we'll go through to this later on. Yes? What is the counterpart of the cash that are that is poured into the company.
Doesn't VC take equity of the company?
Sorry?
Does VC take equity of the company?
Absolutely. The VC takes equity. And the bank?
Bank just gets interest.
Absolutely. So that's the main difference. The bank is a lender, while the company is a shareholder. So he just is an owner of the company. A partial owner, but an owner as well. What is the target? What is the goal? Yeah?
A bank will like to target major company with guarantees and with less risk than smaller companies which are going to bring more performance and more returns on investments, but with risk that is much higher.
Okay, true. Okay, but what is the target? What is a VC or a bank? What are they looking for? Yeah.
I feel like the VC is more worried about the company to grow and to become profitable, while the bank's more worried about having the interest paid to their debt according to the risk of the company at that moment, and it takes a picture.
Absolutely, this is it. This is it. It's the value creation, so the value creation from the stakeholder or the shareholder point of view for the VC, as it is about solvency for the bank. So that's your point. Having the company experiencing some growth in revenue is just a clue of the way that your shares will increase in value. It is correlated. It's not absolutely the same. We'll go through to it as well. But this is just a clue that you're on the good trend. What about the performance? What is the performance of a VC for a given company compared with the performance of a lender, a bank? Hmm? Okay, 20 times. Yeah. Okay. Okay. So the IRR is unknown, but the targeted IRR is very, very high, as the other speaker just presented. As for banks, it's almost nil at this very moment. So it's just the cost of the credit. It's very low. It's in France or in Europe, it's around 2 to 3% per year. So it's very, very low. What is the risk? What is the level or the nature of risk that is taken from both sides?
High and low.
Yes. The sum of all fears for a VC. You have all the existing risk. You have the social risk, strategic risk, marketing risk, financial risk, exit risk, fundraising risk. You have all the risks that are just existing. You will have to tackle them. While for a banker, it's just about having your cash back and having your interest paid. Is there any collateral? Do you know what a collateral is? Yeah?
So I don't know, like, if, let's say, if you can't pay back the money, can a VC buy your company as collateral?
No.
And
No, because he's an owner. That's why. A collateral is like a mortgage for a house. So when you lend money to people, you can ask these people to make available an asset that in case of difficulty for him to pay you back, you will get the asset, have it liquidated, and take money back from the asset. But you will understand that as a PE or as a VC, you are the owner as well. So you can't take any guarantee on yourself. So that doesn't exist. Duration of the partnership?
Long-term, short-term.
Long-term, short-term. Unknown long-term, contractual short-term or mid-term. Absolutely. And the hands-on thing is what you said. So board member on the one hand, and the bank does not want to be involved whatever the way in the management of the company, because it's really risky in terms of liability. So it will just be, in case of covenants that are broken. That means if the company is experiencing some difficulties for paying back money, then at this point there will be some kind of negotiation. But if not, as a going concern, there's no connection between the bank and the company that is financed. Okay, so here you will have some kind of points disseminated. You will see. Question 10, what is the ideal target in the eye of a VC? In terms of market, for instance? Decreasing market, is that exciting? No? So growing market, high traction for the market? Okay, for the team. A team, B team, C team? Yeah? So it's an A team, okay? General Doyo just once said, and he wrote this, better an A team with a B plan than the other way around. Just because an A team will find its path through difficulties, even with a B plan, and it's not true the other way around. What about the product? Yeah?
That will catch a trend of the market.
Okay. Okay. So a must-have product instead of a nice-to-have product. Something that people will pay for. It's not just something. The difficulty comes from the fact that as we're talking about tech companies and VC funding, it is about early adopters that will go into some kind of disruption of the market. So at the very beginning, it can be seen as a nice-to-have product. And you have to make a lot of efforts in order to turn a nice-to-have product into a must-have product as the company expands and go through the mainstream markets. So that's why it is difficult from a VC standpoint to have a judgment on tech, because every technological new product are beginning the same, and they all look like, or usually look like, nice-to-have products and not must-have products. And then a business model must be profitable and scalable. Okay? Question 11. What are the VC's needed skill sets, according to you? What does a VC need to do in the best way in order to, yeah?
Have a good sense of future and how to read your potential.
Yes. Okay.
And then see your personal potential and feel which part you are good at, and then how to maybe hire another CEO to do another second level.
Yeah. Other contributions?
What are the costs of launching an idea? Make it happen.
Okay. Okay. What is the most part of the time of a VC used for? It's about negotiation. Okay? So negotiation skills are really key for VCs, because they are, playing different games with the entrepreneurs, with their stakeholders, with the consultants, the experts, the legal affairs. So they have, and their own teams. So they have to develop very high level of skills in the negotiation. What else? No?
They need to be able to raise money.
Absolutely. Absolutely. This is the name of the game. So there's no, by definition, there's no VC that is able to bootstrap its company, its fund. A fund is a company which is very with a very high capital intensity. So if you're not able, as you just said, to raise money continuously, then the game will finish at a certain point. So effectively. So this was in the European Venture Capital Association in order to attract limited partners from abroad and getting them invest in Europe, saying just providing them with the different skill set they are supposed to find in the GPs that they will back. So focus on business plan, selectivity and specialization, ability to negotiate, management of the inside information. We're not on the stock exchange, so we have to get specific inside information and use them in order to create value. Then strong management, added value, focus, and corporate governance. Okay, question 12. How can an entrepreneur understand the VC's interest? Yeah?
I think all venture capitalists finally they're looking for the money to get multiplied.
Yes. But how can you understand that there is an interest for you as for an investment from the VC you're pitching? You know the statistics. It's about 1 out of 100 companies that are financed at the end of the day by VCs. So it's really, really, really little. And usually it is very, it goes in a very nice way, the fact that you will be in a great company and very interesting conversation. And at the end of the day, you will be 99% out of the pitching companies that will go for nil. So how do you know that you are interesting? You have an interest, yeah? Yes, yes. You can see effectively the number of meetings you can have. What else?
You can compare yourself to the other companies the VC has funded.
Yes. Absolutely, you can benchmark. You can benchmark the actual and the current and the past portfolios. Absolutely. Other ideas? Yeah.
Maybe you can do some research off the VC and see like what market or which industry they focus on.
Yes. Yes. Absolutely. Usually, it's about weak signals. Very weak signals. So, like here, for instance, you just have a look at the hair of the VC, and if there's a shape of dollar that looks like he's interested, even if he has a poker face. So basically, it's really subtle, but you will have effectively some insights of the interest that the VC has for your venture. So, one of the crucial questions when you go in front of a VC in order to raise money is how a VC calculates its stake in a startup. So let's consider this small or medium company named AGA. AGA is, so a VC or PE is deploying 2 million euros into this company. The company has a 3 million euros pre-money valuation. So just before the transaction or any transaction, the value of the company is of 3 million euros, including 0.3 million euros in cash. So if you are in front of a VC investing in the company, what would be the percentage of capital that will be retained by the VC after the deal? 40%. 40%? Everybody agrees? Yeah? Okay, 40%. What about if it's a buyout? If it's a leveraged buyout, if it's a company, if it's a fund buying out the shares? So it's about PE and no longer about VC, but let's consider the company is the same one. Yeah?
Can you explain my audience?
Yes. You, as a P or as a VC, you just raised money, and you have to deploy this money towards the industry composed of unlisted companies. Okay? So you have two different approaches in order to turn your hard cash into shares of unlisted companies. On the one hand, if you are a VC, you are financing companies that are growing very fast, that are not broken even yet. So you have to pour the cash into the company you're financing, right? So you have this 40% dilution. But if the company is self-sustainable, then you can also buy back shares with the same amount of money. And then the percentage changes. So in this second hypothesis, assumption, how much of the capital will you be getting for the same 2 million euros invested? Absolutely. So you win a point. So you see, you have the same kind of transaction. You have, on the one hand, a financier that is managing $2 million or 2 million euros that will be turned into the same company's equity, but in one way, the cash pours into the company, so there's a dilution approach. So the company gets cash, so the total amount of the cash into the company has changed. On the other side, if it's an LBO, for instance, you just have a huge portion of the company, but the company doesn't change in terms of substance. Okay? Everybody's fine with it? It's very important because usually at a certain point, a VC investing in later stage tech companies can do some kind of trade-off and some kind of arbitrage and putting a part of its cash into cash in and another part into cash out. So if you're not aware of these mechanisms, you won't go to the real amount of stakes that will be taken by the financier. So 14 question. How do VCs negotiate the deal's terms and conditions, including the valuation and the quality of the shares that will be subscribed? Is it in a nice way? Is it in an easy way? Is it like you can, be totally confident with the VC and saying, okay, let's create the shares you're asking for and go ahead? What do you think?
They negotiate in their favor.
Whom?
The VC's favor.
Yes, absolutely. And at a certain point, it's a zero-sum game. So at the very beginning of the negotiation, everything's fine. It's like with the analogy my colleague used before with the marriage or the wedding. So the two persons are looking together in the same direction. Everything goes well. But at a certain point, the analogy does not any longer work, and it's a zero-sum game. So what the VC will gain will be the same amount you will lose in the transaction, just because you have to negotiate terms and conditions. So absolutely, you're right. You're having the point. It's really negotiated the tough way. And as you can see, in this specific approach, the entrepreneur will have the special decorative non-equity stock. Okay, so it's really tough, and I can tell it's really tough, just because it's the business model of the VC. The risks are very high. He knows he can't manage on his own the company, so everything has to be to be tackled through the terms and conditions. So the valuation on the one hand, and the quality of the shares that will be subscribed on the other hand, and the combination of both make an investment successful or not by the end of the fund. Okay, so last question to finish. How can research help you understand how VC works, actually? Is it useful to have a look at research paper, or is it's just, you know, for students or professors? Useful? Useless? Who thinks it's useful?
Useful.
Why?
You get to know who you're negotiating against, how they think, what they want, you know, what they're willing to give up, what their hot points are.
Yeah, absolutely.
He's a good VC, by the way.
Yes, he's a good VC. He's very known. And so he published this. What do venture capitalists really do, and where do they learn to do it? I really recommend the lecture of this. You can have the slides afterwards. It's really useful, and it could be some kind of weird idea, because usually research is for, you know, contemplating things that are really deep. And in this particular case, the VC world is really fascinating the research community. So you will find, hopefully, different contributions that are really useful for practitioners, for VCs, and for entrepreneurs as well. Thank you for your attention.